the overall, the banks and the banking system are strong and resilient and well positioned to deal with the challenges they may face now or in the future. So as you pointed out, we do have separate tools, monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation, this is the separation principle, separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. It's certainly possible that we'll see continued supply shocks. I also think it's just very hard to forecast that with any confidence. As Yogi Berra is thought to have said, Ben, you're the baseball expert, you can confirm or deny this, but it is difficult to make predictions, especially about the future. So I think that the best we can do at this stage is probably to just identify the factors that we think can lead to further negative supply shocks. I will say that, though, that positive supply shocks related to globalization largely probably contributed significantly to the period of low inflation that either ended or was interrupted by the onset of the pandemic. And I'm thinking there of the vast increase in global labor supply, the development of efficient global supply chains, facilitated by technological advances and things like that. And I would say those positive supply shocks do not seem likely to be repeated. At the same time, the drivers of the current inflationary surge certainly included a sequence of large negative supply shocks to the global supply chain for goods, which also experienced a large and persistent shift in demand from services to goods, and also the supply of workers. On top of that, Russia's war against Ukraine brought further shocks to global supply chains, particularly supplies of energy and non-energy commodities. So we can't know how persistent those shocks will be or whether further negative supply shocks will come along. Will globalization be partially or fully halted or reversed? Will it resume again as the pandemic mercifully recedes into memory? We can't really know that now.